big market correction happening right now. If you stay till the end, I'll show you exactly where I'm looking to buy in and potentially take advantage of this opportunity. In 2020, the COVID collapse in March, were you trading during that time frame? That was the biggest opportunity of my lifetime since the 2008 housing market crisis. I've regretted not trading the last crash correctly in March 2020. I did watch in disbelief as the market came back and actually broke out to all-time highs within the next month. Everybody that did buy, though, during that decline by now has made a fortune. And I missed it because I traded it incorrectly. So the signs are back. The charts are screaming. This is blood in the streets currently. This blood in the streets event is really knocking on the door here. It's affecting a lot of people. We see the VIX spiking over 30 right now, which is a big sign that panic may be coming into the market, and we could see increased selling here with increased volume. So the market does feel, and comment below if you feel differently, but it does feel to me like it is way overdue for a deep correction. It's been fueled by the AI excitement, and that narrative right now is being fully tested. We are staring down a tangled web of problems: rising energy prices, geopolitical conflict, inflation that seems to just not want to go away, and a Federal Reserve that just kind of seems trapped and unable to make decisive action, a street that is expecting further cuts. You don't have to look far to really see that this is potentially another opportunity. This is an off-risk environment right now. Now, is it going to be another deep decline, or are we going to find support? Consumer sentiment has dipped to its lowest point of the year. The Conference Board's leading economic index keeps pointing downward. So people are not confident right now in the economy. We are in a fragile state where valuations are high. This is the exact environment that can breed panic. And then the storm, as we saw in COVID with the market, even though people were locked down and businesses were shutting down, that really panic turned into greed. Part of that was, of course, the economic stimulus. People had extra money to buy stuff like GameStop, which went absolutely insane. So people started actually looking at the markets as they had more time from home. What did that actually teach us, or teach me? It really taught me that day trading in that type of environment where there is massive selling and a large correction is really like having the blinders on when you've got all sorts of opportunities around you to actually think longer term. So if I had been able to think it through, I would have been most likely not trying to necessarily pick a bottom, but starting to invest the free cash that I had on the sideline specifically for events like that, periodically for each percentage decline in the market. And I actually had a friend do this during that time period while I was trying to day trade. And guess who it worked out better for? My friend, because he actually ended up buying a house with the profits, or at least putting a down payment on a house with the profits from that he made just from that, being able to invest, 2% maybe of the amount that he had available every time it declined, say 5%. So you could see, you can figure it out how much you want to allocate for each percentage drop, but I think there's maybe a better way to do it here. And the way that I'm looking at these declines is actually looking for support around the Fibonacci levels. Now, if you're not familiar with Fibonacci levels are used by many day traders intraday They work basically because they create a kind of self-fulfilling prophecy, because other market participants are actually looking at these levels, and they represent key mathematical proportions used to identify potential support and resistance. And so they do act as a psychological pivot point for many traders and algorithms that watch these same levels. And the collective actions of both retail and institutional traders and algorithms are going to cause the price potentially to pause at least, or reverse there. Many traders also use these levels to set up stop losses, take profit targets, or entry signals. Markets move in waves, and the Fibonacci retracements measure the depth of the correction before the main trend, which has been bullish here in just about every market that you can think of for the past 15 years. So going back all the way to the crash in 2008, and you can see since then we had the other decline. We had the other decline in 2022, as you can see here, and 2020 during COVID. You can see, just looking at the annual time frame, it's not even noticeable. 2022, with the extreme inflation that we were seeing, everything basically declined, including bonds. You can see how bonds as well declined. So what I'd like to do is to actually look at the NASDAQ, the S&P, the Russell, the Dow, gold, and silver, a bigger picture, and see where there may be opportunity for me to enter with the cash that I have allocated on the sidelines that's been waiting for another opportunity since COVID, because I traded COVID incorrectly. I tried to day trade, and that was not the correct way to actually look at a decline. When there's blood in the streets, buy. That's right. But you want to do it in an informed manner that makes sense, so that you're not just randomly buying and blowing all your money when it could decline further. Okay, so these Fibonacci levels do not necessarily mean that price will respect those levels. However, it is an informed way for you and for me to actually get invested at a fair value if you're looking to buy in an account like a retirement account, for example. This is really something that you're going to want to look at more closely and start allocating funds if you're able to. Again, I'm not giving investment advice. This is just my opinion of what's going on right now. And I would like to, because I missed out on COVID, I would like to allocate this cash into investments that longer term I think are going to pay off. So doing that in an informed way, I think the best way to do that is to actually zoom out to the monthly chart. I think this is a really good way to try and find an area where I actually want to start buying in. So potentially, say with $10,000, incrementally investing percentages of that at each of these Fibonacci levels. Okay, so let's take a look at the actual levels here on the monthly time frame for NASDAQ, for example. And what I want to do is look for the most recent potential low here that we had. Okay, so if we go all the way back to April 2025, that was only, okay, so that you can see this huge pin bar here. We went from 17,380 and a high of 20,965. So that is a $3,500 move from the bottom. That was 20%. So simply looking at potential things like options on QQQ or SPX, SPY are going to give you potentially an opportunity to play this out over the next 6 months to a year, and also looking for specific equities that you may be interested in. So buying on the way down here, the first level I see is the 23,280. If I draw it from the bottom of this particular area here, we are at the 618, or we hit the 618 yesterday. So what I'm going to be doing is buying at the 24,000 level, buying at the 23,162 level, and adding in, so dollar cost averaging in on the way down here, because I'm looking for a much larger move. Now it could keep coming down, but with the last, looks like there is this 20,000 is going to be huge psychological level if we're ever able to get back down there. You can see all of these downturns during 9/11. This lasted 3 years and we were completely stagnant and had to wait another 10 years before anything even happened. With financial market collapse, banking industry, housing market crash in 2008, and since 2008 we've just been on a tear. So I guess looking at this is kind of telling me I don't want to put all my money in at once. If you look at the bigger picture, we've got this whole area between 20,000, so 4,000, I'd say, a $3,000 to $4,000 area here that I am very interested in buying. Doesn't mean it couldn't go lower, but this area looks like an area of value for me, for companies in the NASDAQ and the NASDAQ itself. Let's take a look at the S&P. Okay, and can draw out this area as well. So everything between this 5,500 essentially and 6,500 I'm interested in starting to add here. So let's do that with the NASDAQ between the 618 and 20,000 essentially. This is the area that I'm interested in buying in and adding to my holdings. Take a look at the Dow and can do the same thing here. So the Dow is holding up a little better here from that last, again, going back to April 2025 really to look at that last low. And you can see we came down, tested, broke above this 43,000 level. I'll start getting interested in the Dow when we get down here. I'll put an alert here on that. The Russell, let's take a look here. So this is a much wider range with the small caps. And again, this has nothing to do with fundamental analysis. It's a completely separate conversation when you're looking at what could potentially happen based on certain news or economic factors. What I'm looking at is purely technical, and this is the way that I want to find the places where I want to buy. I do not want to speculate if certain sectors will perform better. We can go back and look at historically how certain sectors have performed. I do have a book specifically that covers that. This is an old book on, and this is a separate conversation for another day potentially, but strategic investment timing in the 90s. Okay, so these theories are still applicable today. This is by Dick Stoken, How to Pinpoint and Profit from Short and Long-Term Changes in the Economy. This is a completely separate conversation. What I'm doing right now, what I'm interested in right now is just looking at the technical analysis where I want to actually start buying. On the Russell, we barely made all-time highs there. You can see how that looks compared to the NASDAQ. Has just been explosive. The S&P, same thing, and the Dow pretty much the same thing. So the Russell has really kind of struggled to perform as well The smaller companies have struggled to perform as well as a lot of these larger blue chip names that are, in the NASDAQ and S&P, and sometimes in both, right? Right now, bigger picture on oil. Let's take a look. Okay, so you can see how we actually went negative on crude during COVID there. That was crazy. Can you imagine if you had been able to take advantage of that opportunity? I mean, how unbelievable would that have been? And that is just one month. 1 month, right? Hindsight is 2020, like they say, but there's some way to buy long dated options, calls, specifically, and that you would have just made lifetime money for you and generations. I mean, that's unbelievable how just you had to have the capital to allocate, obviously, but the fact that they were paying people to actually store oil back then because everything was shutting down, the economy was just going to be devastated with the lockdowns and nobody knew what was going on. So understandable fear there, but you can see blood on the streets. If you were able to take advantage of that, comment below. Let me know. I'd be very interested to know how you played it and what instruments you actually used to take advantage of that move over the next 2 years there. And then also looking at gold, we've had a just unbelievable run in the metals markets. You can see in the monthly, this is a bearish engulfing candle. We did engulf this prior month. Wicks on the January candle, highs $5,600 per ounce. And we did touch the 618, and I'm drawing this from the actual May low here. I guess if we wanted to keep it consistent, I could go back to April, see if that made much of a difference there. Let's see. All right, so we just about almost literally touched that if we go back to that April low on 618 on the monthly. Silver, same story here, highs of $120 per ounce. And if I bring that back to April, so we have not got to the 618 level, so be interested in buying silver approaching 55.50 and to see if that level would hold. Otherwise, right at the whole number $50 level, and then all the way down at 44.50 as well. So I'll put alerts at all those levels. So that's the good thing about thinking big picture. You don't have to constantly be looking at your charts. You can wait. It might take a week, it might take a month for these levels to get hit. They may never get hit, but this is the area of that I'm seeing where I'm interested in buying for the longer term. And again, these are not going to be day trades. When I enter, this is for a longer term investment, right? All right, so let's take a look at some of the other assets like Apple. So if we get back down to the $200 level, 195, you can see this would be an area that I would be very interested in because we had this prior resistance at the 194, 195 level, 194 to 200 level here. So I'd be very interested in buying in this area right here. So 194 to 203 potentially. Now again, this might never get down here, but this is, if we are going to see an actual market crash, this is where I would like to see things go. Same thing with Google. So we've got, if you just draw that from the April low on basically all of these tech stocks, I think you're going to find that there is an opportunity here in an area between the 707 and 786 area of interest. Okay, so what haven't we covered here? Right, crypto. All right, Bitcoin lines up quite a bit differently here. We broke below the April 25 lows there, and you can see this is a bit interesting. What would you guys call this potentially? Let's see, we had a double top here back in November 2021. So April, we're trading high of 85,675, and then in October and November, we got up to around 88,455. You can see the pattern play out there. So this is an M pattern on the monthly, breaking that $50,000 hold number level, and that's during 2022, consolidating down there around the $35,000 level. So these patterns are all repeating themselves. So maybe we have the same thing here, potentially a double top, a break down below, right? So I am starting to buy here, and interested in, you can see from this November low, we did retrace back to this 618 from the highs in 2025 up at the 128,000 level. So retraced back to the 618. I'm starting to buy small amounts. I'm not putting huge amounts in here. And there is actually a mutual fund you can buy in your 401k. I think it's called BTCFX Quinn Pro Fund Investor Class. So it can buy $50, $100. Just depends on, what type of an account you have. If there's any sort of fees with Pro Fund, double check that before you actually buy. Let me take a look here. So just looking at the fact sheet. So it does have a pretty, I think, reasonable expense ratio. It's not super cheap, but if you're looking at the gross expense ratio, it's 1.31. So not too bad on this. Total value market of this fund is almost $500 million here. Still a substantial amount in that fund of coin futures. And that's what we're looking at right here. In the 786 to 707, this is really the area where I would like to add. So I guess between 53,000 and 62, and I'll start adding at this prior resistance as well. So this is how I'm looking at this current bloodbath. Okay, so but if we look at the bigger picture, is this really a bloodbath quite yet? Not yet. Keep an eye on the VIX. Again, if we spike back above that 31, just keep your eyes on the VIX if it gets above 30 again for that spike higher, and that's when, all bets are off. Hope that helps. Please, I'd love to hear your thoughts on this as well, and see if this helped you. If it has, hopefully made you think about things maybe a little differently. Get out of the day trading mindset. Look at the bigger picture. Look at these opportunities to improve your life and the life of your children and their children, potentially, like we saw during COVID with this crash in the markets. So plenty of opportunity out there, and I, for one, am looking to take advantage of it. Take care. I want to stop really quick. Please hit that like and subscribe button.